Great. Good morning. Thank you for coming today. This is going to be an exciting open enrollment because we have some really big changes. And I mean, it's a lot. There's a lot of information that's coming your way, but it's really exciting. These new plans that we're going to be offering are different and have an opportunity to save a lot of people money. So I am encouraging you to have an open mind, not just stay with what's been safe and what you know, not be afraid by the word high deductible, because we're going to show you some today about what that means. But there's going to be more to come. So today's session is really what I'm considering a preview to open enrollment. We are not launching open enrollment yet. We are not sending out all the memos with the details. We have a lot of materials that are still under development. So today's a preview to help you learn about the new types of plans that we're going to offer. Through this open enrollment, we will still have the 4 what we're calling traditional plans that you've been on, but with some changes. And we're not going to spend a lot of time on the changes today because that is coming. But I will note that the deductible is going up a bit on that and I don't even actually remember that. It's like $900 for a family, and I can't remember the individual amount. Some co-pays are going up. There are some changes there, and the premiums are changing. But in addition, we're offering for every one of those types of plans you're used to now, all 4, Fallon, Tufts, Harvard, and there's two Fallon actually, you'll have a high deductible option, and that's really where we're going to spend more of the time today. Let's see. So in a few minutes, I'm going to pass this over for you to learn that, but I just want to touch base regarding costs and premiums, because I know that's a big concern for all of us. Of course, what is this going to cost me? And costs are rising, and I don't have a magic wand to resolve that. I wish I did. But we've got some pretty good stuff coming here. So I'm just going to put a different slide up here for a moment. Hold on. I'm just bringing up the rate sheet that you all have in your packet. Okay, so with the rates, there's some good news, there's some bad news. The bad news is, again, that the plans that we've been offering, what I'm referring to as the traditional plans, those are going up. Fortunately, not as much as we thought. Over the past 6 months or so, some of the projections that we were hearing is that we could expect a 10 to 15% increase in the premiums. That's pretty scary. Thank goodness it didn't happen. So, relatively, these numbers aren't as bad. The Tufts is going up 5%. The Harvard plans are going up 8%. The Fallon plans are going up 9.5%. And some good news is we have these new high deductible health plans. So if you move to one of those, you're going to pay less in premiums than you pay right now for your plan. And you may save some additional money, which we're going to talk about how you do that. And I get that whole thing, high deductible is pretty scary. Where are you going to have the money to cover that high deductible? So it's going to be important that you understand what a health savings account is. A health savings account is something that you're going to be able to contribute to, and the town of Concord is going to contribute to. And again, more to come. But the town has decided for this year that we're going to contribute the maximum allowed for a high deductible type of plan. And so that means, in all the calculations that I'm doing, I can't find a way, except in one little case that I'll talk about in a minute, that you would do better on the kind of plan you're on now than on a high deductible. I've been running a lot of numbers, and so far it looks like pretty much everybody's going to save money. And I just want to show you here, so I'm going to talk about, I'm just going to take the example up here in the corner. There's a family plan. We've got Fallon Direct Care, which is a plan we offer now. It's going to have a little bit of changes. We have Fallon Direct Care as a high deductible with an HSA. This line here is the annualized premium. So there you can see on that there's about $1,500 difference that you'd pay less in premiums. In addition, the town is going to contribute $2,000 into what's called a health savings account. And so that means that your net cost for this plan is more like $5,000. And again, you're going to see more, but I'm just giving you a preview, some things to think about, to listen about to as we go through the rest of this presentation. That $2,000 deductible, that $2,000 contribution is going to be available to help you with that deductible that you are going to be concerned about. Say, where am I going to get the money? That's going to help give you the money. And the nice thing about it is if we had put that into premiums, it would be gone whether you had health care or not, right? You spend it, premiums are gone even if you didn't need it. If we put it into an account, if you don't need to use it, you get to save it. And Bill's going to talk about how you save that and how that's going to be used for the future. Right now, if you use it towards premiums, it's gone. Okay, so those are just a few little things to be thinking about as we go forward. Obviously, that didn't just, I just made more questions than I answered. But that's a little preview of some things to listen to. So I think that's where I'm going to stop. I'm going to pass this over to Bill from Harvard Pilgrim. He's just one of the plan reps. We're not promoting any one plan. He just happens to be the one making this presentation for us.
How do we get that back up there? I'm wearing this because this is going to be on the Tonight Show.
Oh, thank you for saying that. Yes, we do have CCTV here recording this session. To tell you that it was in the memo that I sent around.
And I need the clicker. Thank you. Thank you, Amy.
Thank you.
My name is Bill Hickey, and I'm from Harvard Pilgrim Healthcare. I'm here to talk about this new qualified health plan, HSA qualified plan, and I'm here talking sort of on behalf of all of the carriers that offer this plan to the town of Concord. The plans themselves are virtually the same. The HSA works identically the same. There are folks here from Tufts, if you have any Tufts specific questions, but you can see that I've got all three logos up there, so I'm going to talk about all of this in general. This is a high-level description of this plan that you're not that familiar with yet. It's a very common type of health plan in the private sector. It's just gaining traction in the public sector, so we want to introduce it to you. It's going to be available to you as an option. Nobody has to take this. But as Amy said, there are some real reasons why these can be attractive. They're attractive to many, many folks. Some people don't like them right off the bat, but let's walk through them and see what works for you. I'm going to talk away in two kind of segments. First thing I want to talk about is how the benefits are delivered under the health plan itself. You may have heard terms consumer-driven health care, high-deductible health plan, qualified health plan. They're all the same thing. So we're going to talk about the health plan and what the benefits are and how they're delivered. And then we're going to talk about the health savings account. And the health savings account is a funding vehicle that will be provided to you. It gives you the opportunity to pay for your out-of-pocket expenses. And during the course of this, feel free to interrupt me. I'll answer questions as they come along. Raise your hand. I'll do everything I can. If it's something that's coming up soon or in another slide, I'll let you know and tell you it's coming up. Okay? So let's talk about the actual health plan itself, qualified health plans, what the benefits are and how they're delivered. Everyone here is accustomed to the concept of HMOs, and we're going to be talking about this qualified health plan, this high-deductible health plan, is an HMO, which means it's the same networks that you're using. It's the same Fallon, Tufts, or Harvard Pilgrim network. The same operational rules stay in place, meaning you have a PCP and you get referrals for your specialty care, et cetera. Here's the difference. Under the plan that you're under today, you have out-of-pocket expenses that keep coming and keep coming and keep coming in the form of a deductible of, I think it's $250 and $750 on the family currently. It's going up a little bit in 2018. And then you have co-payments that you make every time you receive a service or go to the hospital, go to the doctor. You're paying 20, 40, 35 a year, ER's 100, whatever it might be. It's just every service is a co-payment. The change in thinking here is this is no longer going to be a co-payment-based plan. It's a deductible-based plan. Rather than your out-of-pocket expenses being ongoing at the point of service, your out-of-pocket expense is a single deductible. It's upfront on all services. So all services, and every once in a while I'm going to say, yep, here's an exception. So all services, with the exception of your preventive care, that's your annual exam, your regular physical, that doesn't cost anything and doesn't go toward the deductible. Also, pharmacy that is related to certain preventive conditions, that's not going to be subject to the deductible. Everything else is. All of your other services are going to be subject to this deductible. And the deductible is $2,000 for an individual and $4,000 for the family. The nice thing is, when you have a plan like this, and the reason it's called a qualified plan is because the IRS allows you to have a health savings account. And the health savings account is a tax-advantaged savings plan that helps you pick up and pay for those expenses that are out of pocket. And we're going to talk about how the HSA works after we go through the benefits. So when I said everything is subject to the deductible, I'll say it again, no co-payments. Everything goes toward the deductible with the exception of your physical exam and some pharmacy. And then everything is going to be covered in full with the exception of your pharmacy is subject to co-payments that you're accustomed to today. And I'll show you that on a chart. So I mentioned preventive care is covered in full. That's your routine office visit. Those are your exams, your annual women's exams, prenatal, postnatal, immunizations, all of the same things that don't cost you anything today. It's a defined list by the Affordable Care Act, and it says that no one should have an out-of-pocket expense for these annual exams and the associated screenings and blood tests that go with them. So those remain at no cost to you. But everything else is subject to the deductible. Going to the doctor for an ailment, going to the doctor for a follow-up, any imaging, x-ray, lab, your emergency room services, hospitalizations, hospital-related services, treatments such as therapies, PT, OT. I could go through all the list of everything a physician or a hospital could do, but think of it this way. Everything except your annual exam and certain prescriptions are going to be subject to the deductible. And again, the certain prescriptions are those that are related to preventive drugs. Each of us health plans, Fallon, Tufts, and Harvard Pilgrim, has a different list of the very specific drugs within these categories, and you can find them all online. Also, when open enrollment comes, we'll have a listing of them, a sheet in your enrollment kits. But these won't be subject to the deductible. For Harvard Pilgrim and Tufts, for Harvard Pilgrim and Fallon, they're just subject to a copay right off the bat. Under Tufts, there's no copay. So that's the only difference in the benefits between our two plans. The Tufts preventive drugs don't have a copay associated with it. The Harvard Pilgrim and the Fallon do have a copay associated. Okay? Yes?
Would you be paying the copay or the actual drug cost?
The question is, and I'm repeating questions so that they can hear it. The question is, would you be paying the copay or the actual cost? On the preventive drugs, you're only going to be paying the copay. On the non-preventive drugs, things that aren't on that list, you're going to be paying the negotiated cost, whatever the discounted rate that the carrier has negotiated with a particular manufacturer. Okay? So let's talk about the deductible. The deductible for individuals is $2,000 per plan year. That's from June 1st through May. On a family contract, it's $4,000. The deductible for an individual is $2,000 worth of these services, and once you've reached $2,000 worth of those services on an individual, everything stops. On a family, it's $4,000. But there's a little difference in how it's calculated between the plan you're on now and this plan. On the $4,000 family deductible, so if you have a family plan, any one member of your family can meet that deductible for the entire family. Under the plan you're on today, if it were like this, your individual within a family stops at the individual amount. That's not the case under these qualified plans. Under these qualified plans, any one individual, let's say one member of the family has a hospitalization, costs more than $4,000, then the whole family's deductible is met. Okay? Once you've met the deductible, the only other out-of-pocket expenses are prescription drugs. And they're at the standard 3 levels of copays that you've seen. It would be $10 for generics, $30 and $65 for tiers 2 and tiers 3. And again, that doesn't apply to the preventive drugs. Got a good idea of now how the benefits work? Keeping in mind it's the same stuff that's covered, all the same services are covered, all the same doctors. All this is a change in how your portion, your out-of-pocket expenses are handled. And in this case, your out-of-pocket expenses are handled through an upfront deductible instead of ongoing copays. So let's talk about the deductible. You're accustomed to having a deductible today, so you know that those deductible-related expenses, you don't pay for them up front because the practitioner, the doctor, the hospital, the ER, they don't know how much your deductible is. They also don't know if you've met it. And they don't know at the desk what the negotiated rate for that fee is. You're only going to be responsible for the negotiated rate that the health plan has with that particular provider. So we discount everything, and we've got discounts with all of them. And that's the only amount that you're required to pay, and they can't balance bill for it. How does this work? How do you know? So when you receive a service, that provider files a claim with us or with Fallon or with Tufts. We look at the claim and we process it, we price it, and then we look at where you are within your deductible. And we send you an explanation of benefits, and we send the provider an explanation of payment that says, the service you charged X, I'll pick a number out of the air, doctor's office visit. You charged $200 for this doctor's office visit. The negotiated rate is $100. Sally hasn't met her deductible, so $100 of it's going toward the deductible. You can charge Sally $100 for that service. You get the same piece of information on a piece of paper. You can also see it online. So you now owe that doctor $100. And you can pay for that, and you just pay for that. That's towards your deductible. Now, if it's the first service of the year and you're a family, now you have $1,900 left in your deductible to satisfy. Does that make sense? So an example of this would be your knee's sore. So you go to the doctor's office, and the doctor looks at your knee. That's going to be subject to the deductible, that doctor's office visit. Let's say it's $100 again. But the doctor says, go to the, I need you to have an image of that. Go to the MRI, go get an MRI of it. And so you go get an MRI. That could be expensive. That's going to go to the deductible. And we're going to talk a little bit about the MRIs in a minute. And unfortunately, you've got a torn meniscus, so you need day surgery, and there's a surgeon involved, and there's an anesthesiologist involved, and there's follow-up physical therapy involved. All of this is going to cost more than $2,000 for an individual. But your maximum out-of-pocket expense for this is $2,000 because it goes toward the deductible, and you're capped at $2,000. All the other costs are picked up by the plan. And there are no co-payments for follow-up physical therapy. There are no co-payments to go follow up with the doctor or anything like that. You're done at $2,000. Another example would be, oh, I'm sorry.
Or $4,000 for the family.
Or $4,000 for the family. And because I know I've had this knee surgery, it's more than $4,000, so you would have met the deductible for the whole rest of the family. Okay? Another example would be, and here's how you mix a couple of them together, is if you go to the doctor's office for your annual PCP physical exam, and the cost of that exam is covered because it's, as I said before, it's part of your annual exam. There's no cost associated to the member with that. And the routine blood work that goes with it, yada, yada, yada. But he sees a little bump on your back and your skin and says, perhaps you should see a dermatologist. When you go to the dermatologist, that's going to be subject to the deductible because it's related to treating a condition or a diagnostic service of some kind. Any tests that that doctor orders, subject to the deductible. Any other consults that are ordered with a specialist, all subject to the deductible. Treatments, subject to the deductible. So here's a case where you go in to have your annual physical exam, and there's a, you're sent off somewhere else. Those somewhere else's are going to be subject to the deductible. Yes, ma'am.
But are those somewhere else's, are those prices negotiated too? Or is it a set? Like if you go for a second opinion, is it gonna be $1,000 or how does that?
The question is, are those other services subject to negotiated rates? Yes, everything, all of the services you receive, no matter where they are negotiated rates with the carriers. It's not going to be the same amount for each of us. We each have different deals with hospitals, doctors, and labs, but you can find out what a lot of those prices are by going online with each of our plans, at a high level. And I'm going to touch on that in a second too. So yes, as it is now, in that same scenario, your PCP would have recommended that you go see a dermatologist, and you would have had a referral to that dermatologist, and whatever that dermatologist's negotiated rate would be what you pay, and it would be subject to the deductible. Make sense? So, and this brings right to what you were saying and to the whole MRI thing. Keep in mind that this $2,000 and $4,000 that goes toward the deductible, this is your money. It's your money. So you want to be as frugal and as responsible as you can with that money and start thinking about how you're spending it. That's one of the reasons why these are called consumer-driven healthcare plans, because there's a consumer aspect to this. I brought up the idea of the MRI in the past, and the reason I put that up there is because my daughter had this happen, and I'm on one of these plans. She hurt her knee, went to the doctor. Doctor looked at her 5 minutes and said, go get an MRI. I looked at the doctor and said, does she really need an MRI? Or how about an x-ray first? Because I have to pay for that. And he said, oh, you're on one of those, yeah, why don't we have an x-ray first? Cost a lot less. Turned out she needed the MRI, but rather than taking that MRI order and walking down the hall in the hospital where that MRI was going to cost me $1,500, I was able to go online and go to Shields MRI, a freestanding MRI facility, and I looked online at the Harvard Pilgrim site, and there's I can do a cost estimator, and there's a drop-down that says MRI, left knee, with dye, without dye, whatever it is, and you select the one within a 10-mile radius or 20-mile radius of where you are, and it'll tell you where you can get that service rendered and what it's going to cost you. And that MRI for me was $500, not $1,500 at a freestanding facility. So you can shop for some services. Don't go shopping for heart attack services, but you can shop for things. You can also talk to your doctor about less expensive therapies. You can stay away from the ER if it's not a genuine emergency and go to a minute clinic or a freestanding center of some other kind. A minute clinic office visit costs about $75 for a strep throat. If you take your kid to the ER with a strep throat, it's going to cost you maybe $1,000. So, again, things to keep in mind. Other thing is, under the pharmacy changes continually. So there are new drugs coming on the market all the time, and you may be on a maintenance medication that now has a generic or has a more effective drug, and you guys have just never had a conversation between you and your doctor about what's more effective or What's less costly? Those are conversations to have. Okay? This is just kind of a graphical description of how the plan works again. It's reinforcement. You'll see the top line says it's a plan year deductible, $2,000 on the individual, $4,000 on the family. It also says that there's an out-of-pocket maximum. Disregard that. You should really, it doesn't mean a lot to you. What the $5,000, $10,000 out-of-pocket maximum is the ceiling of any costs that you would have to accrue. Now, because this plan is so rich, after you've met your deductible, you have no other out-of-pocket expenses with the exception of pharmacy copays. So once you've met the $2,000 deductible, in order to get up to $5,000 in out-of-pocket maximum, you'd need $3,000 worth of copays for pharmacy. It's just not going to happen. So by law, all of these plans have to have an out-of-pocket maximum, and it's a ceiling to protect you. But this benefit plan actually protects you from that ceiling anyway. So don't get hung up on that one. If you'll see all the way down, the rest, it's, everything's covered in full, covered in full, covered in full, covered in full. Meet the deductible, then covered in full. And it's all for the course of that policy year. Make sense? So you now have an idea of how the health plan works. So under this health plan, everybody's got an exposure of $2,000 on the individual or $4,000 on the family, plus some pharmacy copays. How do you go about paying for those? Where do you get the funds to pay for that? You do that through a health savings account. Harvard Pilgrim and Tufts and Fallon work with a company called Health Equity. They're one of the largest HSA administrators in the country, and they set up for you a bank account. Anybody enrolled in one of these high-deductible qualified health plans is automatically, and through the town I'm talking about, is automatically going to be handed a bank account called a health savings account. It's an IRS-regulated account that is very similar to a retiree account, but it's used for qualified medical expenses. Things that are the same about it are that any monies that you decide to put into this health savings account through payroll deductions are, they're tax advantaged. You don't pay any taxes on those monies. And the really nice thing about it is that any monies you take out of there, that's not taxed either. You don't get that advantage on retiree accounts. So when you have a retiree account where you put money in tax deferred, that's why it's called deferred. You have to pay the taxes when you take it out. Under these plans, you don't ever pay the tax on the money if you're using it for qualified medical expenses. You own and manage this account through Health Equity, not your employer and not anybody else. As soon as you join the plan, Health Equity is going to set you up with this account. It's your account. The money that's in there is your money, and it's yours for the rest of your life. It's inheritable. You can use it for qualified medical expenses whenever you would like or whenever you wouldn't like. You don't have to use it at all. But it grows and grows and grows as you and your employer can continue to contribute into this account. Other nice things about these accounts are they garner interest. Now, not a lot of interest, the same kind of interest that a checking account would get, so it's 1%, maybe less. I don't know what your current checking accounts are doing, but it's about that. But also, you can invest this money in mutual funds. So once your HSA grows, you can take this HSA and put it into funds that are selected by and managed by, the funds themselves aren't managed by Health Equity, but they're selected. I say, I've got one of these plans and I've got some money in mutual funds. Mine happen to be through Fidelity funds. And that money grows, and it earns interest, and it also grows in value, and it's never taxed. That growth is never taxed. So it's pretty attractive. How much money can I put in one of these? There are limits. The Fed has lots of rules about everything you do when it comes to the IRS. So the limits here are, on an annual basis, individuals can contribute $3,450 into an HSA, and families can contribute $68.50. The sheet you're looking at says the family can contribute $6,900. Well, the IRS changed that on Monday from $6,900 to $68.50. Now, if someone can explain why they had to go through the concept of reducing it by $50, anyway, they did. So it's $68.50. I was able to change this. If you're over 55, you can dump in another $1,000 as a catch-up provision, and this is annual, and it's the combination of your funds and your employer funds. Now, here's another really nice thing about your HSA. And as Amy said, the town of Concord is going to give you half of the value of your deductible, and they're going to deposit it into the HSA for you. Individual contracts are going to deposit $1,000 in, and on a family contract, they're going to deposit $2,000. And you can do it, that money is yours. They can't take it back. It rolls over. It's yours to use for qualified medical expenses. Yes, ma'am.
It's a one-time $2,000?
This-
Or is it yearly?
The question is it a one-time $2,000? It's an annual amount. Now, how much the town puts in is subject to union negotiations annually or every 3 years, whatever you do, however you do that. But in this case, and they're putting it at the beginning of the plan year. So at the beginning of the plan year, sometime in June, your HSA account is going to have a deposit of $1,000 or $2,000 into it. You also have payroll deduction availability to go into that account, and the payroll deductions are free of taxes as well. Yes, ma'am.
Is that $1,000 from the town taxable?
The question is that $1,000 from the town taxable? The answer is no. So the money that goes into your HSA from the town or from you, you will never pay taxes on it as long as you use it for qualified medical expenses.
Sorry, another question. So do you have to claim that when you do your taxes?
Question is, do you have to claim it on your taxes? The answer is no.
Do you say anything? Okay.
No. Okay? So, again, I mentioned that it's an IRS-regulated account, so that means there are rules. There are a lot of rules. In order to contribute to an HSA, you must be enrolled in a qualified high-deductible plan, the kind that's being offered here. So what that means is if you no longer participate in one of these health plans, let's say you leave employ, or you decide at annual enrollment to change, to go back to the other plan, and you're no longer on a qualified plan, you can no longer contribute to the HSA. But the money that's in there is still yours. You get to keep your HSA, and you get to use the money in it for qualified medical expenses. The only thing is you can't contribute toward it while you're not on a high-deductible plan. The other thing, oh yes, I'm sorry.
Is it the same if you retire?
The question is it the same if you retire? Depends on what other coverage you have. If you retire and you're still on the if you retire before you're Medicare eligible and you're still on the high deductible health plan, retirement doesn't matter. It's whether you have additional coverage. So your employment status doesn't matter on whether or not you can have an HSA. If you're on the qualified plan, you can have an HSA and you can contribute, your contributions can continue. If once you're Medicare, then you keep your HSA, but you can no longer contribute to it. And that's line number 3. So if you're on Medicare, you can't contribute to your HSA. You can keep it, and the monies that are in it you can use for the out-of-pocket expenses that you have post-retirement and that are associated with your Medicare costs. You also can't be claimed on someone else's taxes as a dependent. Everything okay? Yep. You can't be in the active military, and you can't be currently enrolled in a full flexible spending account. So if you have a flexible spending account now, you've got to empty that out and be done with that before you can have an HSA. You
have to have it all used up before even that contribution from the town.
The question is, do you have to have that all used up before you're contributing to the account? Yes, you can't be participating in an FSA and an HSA at the same time.
However, Bill, we're going to be adding a limited purpose flex spending account option that'll go along with this open enrollment. And you can roll over anything you had in a healthcare account this year, flex spending healthcare account. You can roll it over up to $500. That $500 rollover, you can bring that into a limited purpose. The limited purpose, you will only be allowed to use for vision and dental expenses.
And the reason for that is because you're allowed to have what's called these limited purpose FSAs with an HSA, because all of your medical out-of-pocket expenses are covered by the HSA, and vision and dental for that matter. But so the point of this is a full scope FSA, which you guys have access to now. You can't have one of those and a full HSA at the same time. Okay? So what are qualified medical expenses? They happen to be the exact same medical expenses and that are on your FSA. So all of your deductible can be funded through your HSA. Any copays you have, and in this case, those copays would be copays for your pharmacy, any coinsurance. I don't think you have any coinsurances on this plan, but eyewear, eyeglasses, vision, dental, all the things that are associated with dental and family. So if you participate in the town's dental plan, you have copayments and you have out-of-pocket expenses. Those are also eligible to be reimbursed through the HSA. And so are expenses that are not covered by dental. So the question came up at the last meeting about orthodonture. So you have orthodonture expenses, you can pay for those out of your HSA. They're not covered by your dental plan, but you can pay for them out of your HSA. Another thing about the HSA is, unlike the FSA, which you can spend your entire year's contribution on day one and then catch up with it, sort of like a loan, under an HSA, you can only spend the money that's in the account. So as you contribute, and as the town, in the town's contribution, which is an upfront contribution, and if you contribute over the course of the year through payroll deductions, you can only spend what's in the account. If you spend HSA money on things that are outside of qualified medical expenses, like a boat or a car or whatever, I don't know, then that's going to be taxed. This is a lot like a retirement account. So if you take money out early, it's taxed. And if you're under 65, there's also a penalty. So the encouragement here is spend it on medical expenses. You're all going to have out-of-pocket medical expenses for the rest of your life. And that's what this is for. Yes, ma'am.
And what is the procedure for having the HSA pay for something like a dental or
The question is, what is the procedure for having the HSA monies pay? And that's coming right up. How it works, how you get the money, and how you pay the providers. Yep. I saw a hand up here, over there, yes.
So if you were, let's say you had $4,000 of expenses at the day one of the plan year, and there's only the $2,000 account contribution in there, is there a procedure where you can get a reimbursement if you go ahead and pay that bill for money that's building up in the HSA as the year goes on?
So, yeah, the question is, if you have greater expenses than you have available in your HSA at the time, is there a mechanism to manage that shortfall? Is that essentially what you were asking? The answer is yes, but it's up to you. The first thing you keep in mind is you're going to get an upfront 50% of your deductible. In your example, $2,000 the town is going to put in there very early. If you've elected to only contribute $100 a month, let's say, into your HSA, you're not going to have the full $4,000 in there. What you can do, if you want to have HSA money, You can do a couple things. One is you can pay out of pocket and then reimburse yourself out of the HSA once it's built up. Or you can write a check to your HSA on a lump sum payment and take that amount off a top line on your next year's taxes.
I also just want to note about that, doctors' offices understand all this, and they're great about providing payment plans. I can say, but I'm on a high deductible plan through my husband's employer. When I had an Emerson bill last year, that was the very beginning of the plan year, so it was exactly that. I didn't have the funds. I called them up to see if we could have a payment plan. They didn't tell me what it was going to be. They asked me what it would be. They said, well, how much can you pay? I was hoping for maybe $200 a month. I went to 50. Like, how about 50 a month? Sure. Okay, we'll put you in for that. It's that easy. Now, I can't say with every single provider, but any provider that I've interacted with, they just want to know that you are making those payments and that you've got it coming for it. You're staying in touch. Don't ignore the bill. That's not good. Be in touch with them, and you can work that out.
Amy's point is very good. Providers are more than happy to extend payments. And also keep in mind, it takes sometimes 60, 90 days to get a claim in, processed, over to the provider, and then the provider to bill you, and then they give you 30 or 60 days after that. So, it's very rarely are you going to be in need of actually coughing up any cash in the first 30 or 60 days before anybody's looking for you. Yes, next. I saw that.
Whether you have an individual or a family plan, if something were to happen to you as an individual or you as part of the family plan, whether you leave the town's employ or or something happens to you, what happens to that money? Like, as far as if for an individual, if there's an estate, I mean, the money that the individual or the family person, not the town's portion, that's sitting in that account.
So the question is, and I'm repeating the question because of this thing. The question is, what happens to the monies if the policyholder, the bank holder, the subscriber, is no longer with the town or no longer with us? Something happens to that person. The HSA bank account is inheritable. There's a beneficiary form. You can put a beneficiary on it. And as a matter of fact, and this gets kind of into the weeds, but your beneficiary can use it for medical expenses too, or your beneficiary can just take the cash and pay the taxes. Okay? I saw another hand. Yes?
It says to have the HSA, you cannot have other health coverage. Does that include vision and dental?
Question was, it says that you can't have other health coverage. Does that include vision or dental? And the answer is no, it does not include those. It's health plan coverage. So you can't be covered by another health plan, meaning like you can't be a dependent on somebody else's plan if you're with your on a spouse's health plan, something like that. There's another little piece to this too that I want to keep in mind. The only eligible expenses are for those people who are your tax dependents. And this is another little tricky thing for a year. It gets into people who have kids covered under their health plan but aren't their tax dependents. So because you're allowed to have a dependent on your health plan up to age 26, they may not necessarily be your tax dependent, but the HSA money can only go toward your tax dependents. So if you've got a kid who's not your tax dependent, you can't use HSA money for their portion of medical expenses through your HSA. But what you can do is they can open up their own HSA. They're on a high deductible health plan. They can have their own HSA, and it can be funded pre-tax or no tax just as well. That's kind of a little technical thing for the people that happens to.
So when you say that they can, because I have a child that's 23, out of college working, so are you saying that he cannot be on the HSA through me?
The question is, and the example being, she has a child who's 23, working and out of college, and the question is, he can't be on an HSA. Well, no one's on, no, so he can stay on your health plan, but your HSA monies aren't supposed to go toward paying for his out-of-pocket expenses. It's your HSA money, you're the contributor for you, your spouse, and any tax dependents. That answer it? Okay.
What is the age?
The question is, what is the age? Well, there's no, I'm not a tax attorney, but you, as long as you declare someone on your taxes as a dependent, then they're eligible. I have a 21-year-old. I claim him, and I have a 25-year-old that I don't claim, and they're both on my health plan. One more?
What if you only want to contribute 500 towards the deductibles? Do you still get the 1,000 from the town that first year?
So the question is, what if you only want to contribute $500, and you used the word toward the deductible? I'm going to change that to contribute to the HSA. Does the town still contribute that same amount? The town is going to give every employee that joins this plan $1,000 or $2,000, regardless of what your payroll deductions are. Okay? Another? Yep.
So right now with the FSA, we contribute a certain, like it's kind of put on your card up front, and then you have it taken out of your paycheck. For the HSA, we make a decision as to how much we want to put in, and then, like you said, it could be taken out of your
I think I get-
somewhere.
yeah.
I
So
don't understand how that.
the question is, as opposed to the FSA, which is a defined amount you select every paycheck, and that can't change over the course of the year, how does the payroll deduction work with the HSA? So you would, at HR, somewhere in HR, you would elect a payroll deduction amount. You can do it on a lump sum. You can change it regularly. So if you think you might need HSA monies toward the end of the year and you haven't put any in there, go ahead, change it. Change your payroll deduction amount. So you're allowed to change your payroll deduction regularly, unlike the FSA, which is locked in at the beginning of the period. And you can make it as much as you want up to those maximum amounts. And the maximum amount is inclusive of the town's contribution. I'm just looking at your eyes. Did that answer your question?
Somewhat, but I guess it's just my brain, so the town's giving us $2,000 in that account,
Yes.
and I decide I want to put whatever that balance is to max it out, but I have it taken out of my payroll. Is it in there already at the end of, like, right now,
No.
Like, is it?
So the
The
question is, if you elect X amount to go in to be taken out of your payroll and into the HSA, is it all in there already? The answer is no. It's real money. As it comes out of your payroll, it goes over to the HSA. It's not a loan like your FSA is.
Thank you.
So if you elect to contribute to your HSA and you have a payroll deduction of a certain amount, that amount will continue until it reaches the contribution limit, like for a family, $6,850?
The question is, if you elect a payroll deduction to come out on a regular basis, will that continue until you reach the maximum? It will not stop automatically. You need to do the arithmetic and figure it out, how much you want to put in. Up to this, if you put in more than $6,850, you're going to get a call from the IRS. Maybe not, but.
What was the maximum for the individual?
Individual is 34, did I say 3450?
Yeah.
And yeah, it's on that sheet. Yes, sir, back there?
So I guess in answer to my previous question, you had said that if you don't have enough money in there, you could actually make a deposit in effect to your HSA. So is it fair to assume that, let's say you suddenly have more expenses than you thought, and you go ahead and you get that $1,500 bill coming
it is a little convoluted. I'm going to simplify it so if you have an unexpected expense and you would like to pay for it with tax-advantaged monies, the ways that you can do that, and you don't have enough money in your HSA at the time, the ways that you can do that are a couple. One is you can go to HR. I hate to keep telling the HR folks this, but you can have a lump sum payroll deduction. That would be tax advantaged. You can also pay for it out of pocket, and then once your HSA has grown, you can reimburse yourself with those tax advantage monies. Or you can make a lump sum cash payment to the HSA out of your private funds and take that as a top-line credit off your taxes. Now, the only thing about that, and again, this is another in the weeds thing, the only advantage you're going to get is on federal income tax. You won't get an advantage for state tax, and you won't get an advantage for your Medicare and Social Security. We're getting into taxes now. It's that time of year. I'm sorry.
Does the account keep track similar to like the FSA on where you've been, how much you spent, or what?
So the question is, does the account keep track of where you've been, what you've spent, all that kind of thing? It sure does. And I'm going to explain how it does. So how does this work? How does it work with the HSA? And that question came up earlier, and I'm sorry I didn't get to it till now, because we have a lot of questions. So when your HSA is going to come to you in early June, you're going to get a card. You're going to get a debit card. So how does it work? When you we'll use the same old example I gave. You've gone to the doctor's office. You've got a $100 fee that is your responsibility because it went toward the deductible. You're going to get a bill from the doctor. And on that bill, there's usually a tear-off piece on the bottom where you can either say check enclosed or you can write a credit card number. You could write that credit card number on there. So the other thing you can do is you can just pay that bill out of your pocket and reimburse yourself from the HSA. Or you can, and we're going to get to this in a second, or what I'm going to show you in a minute is you can go to the Health Equity site, and you're going to have your own individual private site where all of your claims are up, one by one, individual claims, and each one of those claims is going to say what the charge was, what the allowed amount was, the negotiated fee, how much went to the deductible, and how much you owe after the claim's been processed to that particular provider. Because remember, what I said earlier was we're integrated with this HSA provider, so we send them all the claims after they're processed. And when you look at it, it's going to say, Dr. Jones, $100. Oh, no, it's going to be Dr. Jones, $200, allowed $100, to the deductible, $100. You owe Dr. Jones $100, and you're going to get a bill for $100. You can pay, there's a radio button on that, and you can just touch a button, and the HSA will pay the doctor for you. Yes?
So basically, we will not be signing in on an individual basis to say Harvard Pilgrim. We will all, whether you're Harvard Pilgrim or Fallon, we'll be using Health Equity as more of a login to track things, correct?
The question is, would we be using Health Equity as opposed to the health plan for login? And not really. Both of them have different usages. The HSA plan, Health Equity, is what you want to use to pay for qualified medical expenses and to manage your bank account. The health plan is a great site for all of the things that health plan websites provide you, like cost estimators, what the prescriptions are. It also has all your claims on there, and you can verify them, but we're sending them the same information on claims that are processed as you would find on the health plan's website. But they do have different features.
And one other question. On the age 55 and older, where you have that $1,000 catch-up, so then if you were over 55, you could put in $7,850 contribution, correct?
Yes, the question was, if you're over 55, that $1,000 contribution that just expands the maximum from 6,850 to 7,850 on the family. Did I read those numbers right?
Yeah,
Yeah.
and so is that, the reason for that is because assuming that somebody's 55 and older would have more health expenses? Is that?
The question is there assumption behind that someone over 55 would have more health expenses? No. The assumption is that that person has a shorter window in which to build up their HSA. Yes?
Are you allowed to use the HSA funds for alternative therapies like acupuncture, massage?
The question is, are you allowed to use your HSA funds for alternative therapies such as acupuncture and massage? And in many cases, yes. It's the same list that you would find for your FSA. And all you have to do is Google FSA, and it's going to give you a list of everything that is eligible, or Section 10, IRS, Section 213. Not all of them, not everything, but yes, many of those alternative therapies are eligible. I'm going back to, I'm going the wrong way. So I'll go back this way. So we were talking about how do you actually get these funds, I'm sorry.
I'm sorry, just one more. Because this is getting implemented in the middle of 2018, we'd be expecting that for this year, we would be talking about half of all of these limits.
Great question. The question was, because it's in June, are we talking about only being able to do this half a year? And I think you asked that under the assumption that this is based on calendar tax years, which is not the case. Everything is based on plan year. So everything is on a plan year basis. So your total maximum contribution is a plan year contribution. Yes, sir.
You mentioned a couple of times reimbursing yourself if you pay something out of your own account. I'm not quite sure how that would actually happen.
The question is, I mentioned about reimbursing yourself. How does that actually happen? 1 second from that. I talked about how you can pay for your medical services. There's one that I didn't mention is pharmacy is live. That's a live system. So when you go to the pharmacy, and if you've got a copay for your pharmacy, or if it's going to go toward the deductible, when you slide your medical card, your Harvard or your Tufts or your Fallon card, it knows right away what your out-of-pocket expense is. So you can pay for that right away with your card. Yes?
So, plan year, June 1, May 31st, that would be like when your deductible, so your deductible, it's not calendar year for your deductible as well, correct? So like.
Everything is.
January 1st hits, like it's not January, December, it's June to May.
Everything is June to May.
Thank you.
Back to the reimbursement aspect. So as I mentioned, you have different ways of accessing your HSA. One of them is to reimburse yourself. If you have qualified medical expenses, doctor's office visit, and you decided to write a check for $100. You didn't want to take the money out of your HSA. So you pay for it out of your pocket. You have a receipt that you paid the doctor $100. It's a qualified medical expense. You can reimburse yourself for those out of your HSA in a couple of ways. One is on your personal website, along with the radio button that says Pay Provider, there's another one that says Reimburse Me. You can and what some people do is, as I mentioned, remember your HSA is growing, and if you have it invested or if you keep putting money into it, so as that grows, remember it's all tax-free. So in the case of what I did, on the smaller expenses, I've paid for them all out of my pocket as those monies sit in my HSA that I own and I can use. And one of these days, I'm going to reimburse myself for all of those that I have receipts for that I paid for outside of the HSA.
And can you reimburse yourself at any time, or does it have to be through that calendar year?
The question is, can you reimburse yourself anytime, or does it have to be in that calendar year? You can reimburse yourself anytime, 10 years, 20 years, doesn't matter. As long as you have a receipt, because, unlike an FSA, where you're oftentimes asked for evidence, you're not asked for anything here. You're managing this account. If the IRS comes along and says they'd like to audit your HSA, show us the receipts for the things that you came out, you want to keep those. Now, the Health Equity website keeps track of what you pay for out of that HSA, so you could always just download that. But if you want to reimburse yourself, you'll want to have some evidence that it was for a qualified medical expense. Okay? So you're going to get a whole kit, a little kit. It's got a debit card in it. It's going to tell you how to reimburse yourself. It's going to tell you how to pay for providers. And you're going to get 2 cards, one for you, one for a family member. If you want additional cards, they're going to charge $5 for additional cards. And again, you can keep this HSA, you keep it forever, and you use it forever. It's just the only thing that you're limited to is you can't contribute to it if you're not a member of a high deductible health plan or have other insurance. Those are that list of rules we had. I mentioned investment options. Like I said, the cash that's in there is going to earn minimal interest just because it's like a checking account interest. But if you have $2,000, a minimum of $2,000 in your health equity account, you can take other monies and invest it in funds that they have as options. And they range from very conservative to pretty aggressive funds. And all of that information is also on the HSA website. Yes?
So if you make those investments perhaps not wisely, you can lose that money.
The question is, if you make those investments unwisely, could you lose the money? Future performance is not an indicator of blah, blah, blah. Yes, absolutely. They are at risk, any mutual funds. Here's a little kind of a description of the HSA Health Equity Portal. This is, on the left-hand side, is what the welcome page looks like. And you can see it there better than you can see it in front of me. But on the top left-hand side, it says your account balances. And it'll show your account balance in your cash account and your investment account if you have one. And then below that, there are quick links. You can look at all your claims. And when you look at your claims, you can sort them by family member, by whether or not they've been paid or not paid, whether they've been settled or not settled. You can sort them by year. It's a very robust site. It's pretty good to work with. So, yes, ma'am.
If dental and eye were both listed as covered, are you restricted to I've been going to the same dentist for many years. Are you restricted to the dentist?
The question is, are you restricted by any providers for HSA monies? No. The only restrictions that you have for particular providers are through your health plan. So your health plan has a network, and your dental plan has a network. And if you're outside of that network and you have medical or dental expenses, then by all means, use your HSA monies to pay for those expenses. How we doing? Because that's it.
I just, sorry, one second. I just want to mention, and this is kind of a preview to open enrollment. Sorry, thank you. This is a preview to open enrollment. We have lots of more materials coming your way that we are working on. We have a benefits counselor app that's coming, this thing called Alex. The little video I was playing at the beginning came from that same product, but the benefit counselor will allow you to do things like say, would you calculate what would happen if I had 2 surgeries this year, 5 prescriptions, this sort of thing. It's not going to be an exact amount, but it will go through that and help you select which plan would be right for you, given that. We're working on some other things, a lot of costing scenarios. So you're really going to want to be able to see, okay, how much is this going to cost me? I'm afraid of that deductible. We're working out some scenarios where you say, okay, you're paying this much in premiums, your exposure is this much through deductibles, but you've got money from the town in this case, and then, no, you don't have to pay any more. There's a lot more coming that we are going to put together, so just wanted you to be aware of that. And, oh, actually, and one last thing before, so that we do it. I want to make sure I introduce our human resources team. Go team, if you guys would all stand up. We're all here to help you through this and to help each other. We are not going to know the answers to everything, but we will know where to get them. So we have Shauna Canerney, Marie McCann, and who are you? No, I'm sorry, Stephanie Oliver. I'm kidding. But Erin, would you stand up too? Erin Mulcahy, used to work in finance. Now she works partially in finance, partially in HR. She's been a big part of helping us with this too, a little more behind the scenes, but on the technical things. And she's also very informed on this. So this team is going to be the front, but she's also a big part of it. So I want to acknowledge her. And thank you to everybody for getting this going.
We'll stick around. Any questions you have? Yes, sir.
Free preventive care, I always get a bill for, they'll find something to bill me for routine eye exams, or we did a glaucoma test, or we did this. Now, I'll walk in and say, this is my free eye exam, right? So please don't do anything that you bill me for. And invariably, I get a bill, and I'm wondering, does the plan help to counteract that or combat that? Or is that
The question was related to how people often get bills for what they believe are or what they hope to have had are listed as preventive annual exams. And does this type of health plan help in any way to prevent that from happening? And the answer is no, this plan doesn't change that. The issue at hand is how physicians code and bill those particular procedures. And if it's going to be coded as a diagnostic, and an example being glaucoma test, they're looking for glaucoma, or they suspect glaucoma, or something along those lines, or if it's a follow-up. So these codes and the actual specific codes for the services as well as the codes for the blood tests that are listed by the Affordable Care Act to be free are very specific and very succinct. So if they come into us without that code,
So if you have an annual physical, but part of that is the doctor routinely assigns a particular test that's not on that schedule, you will get that.
yeah, the comment was if you go for an annual physical and there are tests that are not considered part of that physical, would you get billed for it? The answer is yes. So what the ACA determines as your annual physical and the associated tests is not what many doctors' offices consider to be a complete physical. Yes.
Just to clarify, so if I'm a 23-year-old, not on my taxes, under my health care, I can't use my HSA, however, it will still go towards my deductible.
Yes, that question was, if I have a covered dependent who is not eligible for HSA, who's not a tax dependent, and therefore not eligible for HSA reimbursement, will those expenses still go toward the deductible? The answer is yes.
And can I just add that, and then once the deductible is met, all medical expenses are covered in full for that individual as well as everybody else.
And can I just expand on that, because I just so you had also mentioned that they could hold to a separate HSA?
So the question is, could they have, in this situation where you have a covered dependent, and by the way, yes, the question is, can that covered dependent own their own HSA? And the answer to that is yes. Not through health equity. I mean, you could go to health equity and buy one individually. But but they wouldn't get one through the health plan here. But they could buy one from Bank America, they could buy one from Health Equity, for that matter, or they could buy one from Wells Fargo. All major financial institutions sell HSAs. And all that child would have to do is exhibit that they are a member of a high deductible qualified health plan. They can open up their own. It's not commonly done. I happen to have done it for my daughter, and then gave her the money. But she had to make the deposit. Don't we always give them the money? It's just the fact that I'm giving her money now, it's just like a tax, she gets the tax break.
What's different is if I gave one of my kids the FSA card to go do their deductible, currently, they can't take mine, if they're not a tax dependent, my HSA card and pay that same copay.
Well, the question is, can a dependent use your HSA card to pay for those things, and they're not a tax dependent? They can do that until they're caught. So there's nothing to stop. There's nothing, they're not going to get stopped. The doctor's office isn't going to say, hey, I don't think she's a tax dependent. But if you're audited, you'll have to show that they're eligible expenses.
It seems to me that the doctor's offices are pretty routinely asking for a copay right when you show up for the appointment. And if you kind of know you've made your deductible and you're supposedly in this, where everything's covered, what do? Just sort of decline to pay the copay at the point of going to that appointment?
The question is, I'll try to paraphrase it. So if at the doctor's office asks for a copay and you don't have a copay to pay, what do you do? So in this case, there are no copays for doctor's office visits, and your doctor's office is going to know that because you'll have shown them your new health care card, and so they will not be asking you for a copay. Right now, your ID card says on it, copay $20. Your ID card is not going to say that. It's going to say subject to deductible. They're not going to ask you for a copay, and even if you have not met your deductible, they can't ask you for any deductible-related expenses either.
So we should expect that we're not going to get asked for copays. That's what I didn't feel.
Yes, as long as you're not going to be asked for copays, as long as your doctor knows you're under a new health plan.
Right, so you show them the new card.
Yep.
And then they send the bill to Health Equity for whatever that.
No, they being who? The doctor?
The doctor.
No, so the doctor's office sends the bills to the health insurance plan.
Health insurance sends it to.
No. So the doctor's office sends the bill to the insurance company. The insurance company determines how much should be paid, and then we inform Health Equity about what that processed claim looks like. So you, as the member, can go look at it and pay out of your health savings account. But the medical provider has no interaction with Health Equity.
But the provider, the medical provider will be sending you whatever they're still due anyway, so.
The provider sends you a bill for what's due based on what the health plan tells them. It has nothing to do with what Health Equity or the HSA. The provider and the HSA are very distinct from each other.
But is that bill going to come after it's gone through all of these processes, or is it going to come out quick like they do now and we'll get told to wait?
The question is, does the bill come out after all these processes? The bill can't come to you until the health plan has processed the claim. In some instances, I know that providers shoot out bills before there's been an insurance claim made. I would tell everybody, in any case, no matter what kind of insurance you have, never pay those. Don't ever pay anything like that until the insurance company's had a look at it. That's the same now.
So what happens when that has gone through and then you get another bill?
When you say,
So it says the health insurance is paid, this is what we've owed you, whatever your agreement is, but they don't agree, almost like a balance.
oh, okay. So the question is, what if you get,
I don't know if it has anything to do with this or not.
so if you get a bill from a provider and it's already been through the insurance company, and it's going to say on the bill, the statement, it's going to say, $200, adjustment $100, you owe $100. And are you asking me, what if that doesn't agree with?
Is that something we're supposed to pay?
Oh, yes, because that goes toward the deductible. So if you get a bill from the provider that has been, and the claim has been processed by the health plan, then the out-of-pocket expense, or what's going toward the deductible, is what your responsibility is.
What if you paid the deductible and there's still a balance?
If you've already met your deductible and they're still billing you, then you better call member services, because when we process that claim, we would have noticed that the deductible was met and told the doctor they can't bill you.
The way you can tell, so you get a bill, you look to see if it mentions that insurance is paid, then you go online to Health Equity. The amount of your bill should match what the Health Equity account is showing that you owe. If it doesn't, that means that the doctor hasn't processed it right, or is billing you for something different than what went through that process.
And you can also check it by, again, calling the health plan's member services. You say, I got a bill for something, I think I met my deductible. Is this legit? And they'll tell you. You can also go online to the health plan and look at your claims online to verify it too. But these scenarios you're bringing up are not specific to this health plan. They're general health plan questions. Yes?
So this was great for how the high deductible plan works in the HSA. So now, I think what Amy was saying, you can use Alex, or there'll be more information to decide, is this the right plan for you, or should you remain with the older fashioned plan? Because some of us have fewer health expenses than others, and we need to compare.
That is correct, but I have done a lot of different scenarios, and I have not yet found a scenario where you would save money on the traditional plans because of the amount that the town is contributing to the HSAs. But we're still doing the figures, and we will roll all that out to help you make that decision.
So I looked at this quickly and without my glasses, but so on a family Harvard Pilgrim plan, it looks to be the savings in the employee premium, between the regular HMO and the HSA HMO, under the annually, if you're to, let me just make sure I'm in the right spot. Oh, okay. So on a family basis for the Harvard Pilgrim, the total cost out of pocket for your payroll deduction under the regular plan and the old plan is $12,220. Under the HSA plan, it's $9,655. The difference of that is what? Close to $3,000, right? I can't do that in my head. So let's say, so if you were just to take that difference and put it into your HSA, along with the $2,000 that the town gives you, you already have an HSA that is funded to a greater extent than your deductible. You're already ahead of the game.
Do the pointer? Well, doesn't matter. If you look at, this line here, change in biweekly deduction, where you see the red, that shows you how much you will save in premiums if you elect the high deductible plan over the traditional plan for that provider. So for in this example, if you stay in the Tufts EPO, which will have some new costs, some new deductibles and copays, if you stay in it, your biweekly deduction is going to go up about $25 for each period. If you say, well, I'll try this HGHP, this high deductible, you will pay, is that $70 roughly per pay period less in premiums than you are paying right now. So about $140 a month. This is not, over here, not quite as much. If you're on this end, you're talking about, you'll pay about $65 or so less per month, that much per pay period. If you took that money and you said, I'll just keep paying what I'm paying now for health insurance, and you put it into your health savings, you ask us to take that amount out of your paycheck, put it into your health savings account, you'll start building up what you need to cover a deductible. Okay?
I could then in turn write a check for $1,000 and deposit that.
Your question is, could you, along with your payroll deductions, could you also fund it with a check? And the answer is yes, but only to the extent, to the maximum amount. Yes, sir. I'm sorry, I didn't hear you. Did you ask, is the payroll deduction mandatory? No, payroll deductions are not mandatory, but the tax advantage from having it through payroll deductions, you get a greater tax advantage because it's because of state and Social Security and Medicare taxes, which you don't get if you write a check.
You can't take it from your existing flexible spending account.
I can't, I'm sorry, I can't hear you.
Your existing flexible spending account can't be transferred into.
No, you can't transfer FSA money into an HSA.
There's no max on the HS on this, right? So if you just kept putting in, and you weren't using as much as you're putting in, there's no max, because you said it belonged to a beneficiary or whatever.
Yeah, is there a maximum to the amount that you can have in an HSA? No, no maximum amount. No. Okay?